Hi everyone, Brian here, and in today's video I plan to cover how to buy treasury bills, notes, and bonds. I will also discuss the key differences in each of these assets, along with the different options for how to buy them. Overall, this video is part of my series on Investing 101 to give everyone a baseline understanding of some of the basics of investing. For this video, I plan to define these three assets, discuss the reasons for buying them, how to buy them, and the pros and cons associated with each purchasing option. Each of these assets are a debt security that is offered by the US government that has a fixed interest rate and a maturity date. Essentially, they're loans that you are giving the US government with the expectation that they give you the principal plus a little bit back in interest. The key difference between each security is their length of maturity. Bills are short-term securities that mature anywhere between 4 weeks and a maximum of 1 year. Notes are sort of in the middle with maturities that range anywhere from 2 years all the way up to 10 years. And the bonds are the long-term securities that mature either at 20 or 30 years. I'm going to focus most of my discussion around the short-term bills, but just know that the key differences between each of these is mostly the maturity date. How they are purchased and sold is essentially the same process for each asset. However, one of the key differences is how the interest is paid. For a bill, you buy the security at a discount. As you can see on the screen, a $100 bill with a 26-week maturity date is being sold at a discount equal to the rate it provides. So you would pay $98.05 for this particular bill, and in 26 weeks you would then receive the full $100. A 26-week bill is half a year, and the interest rates shown are for a full year. So if you divide the annual rate for this bill by 2, since 26 weeks is half a year, then you get 1.93%, which is roughly the percentage yield that you get for this bill for 26 weeks. With longer term notes and bonds, you pay the full price at the point of purchase, where the interest is paid out each 6 months until maturity. Because bills are 1 year or less in maturity, it doesn't make sense to pay interest before maturity. So why would you want to buy treasury bills, notes, or bonds? In some cases, there may be a high-yield checking account that has a much better rate than these types of assets. So why go through the process of buying them? To begin with, these securities are extremely low risk. Unless the government goes bankrupt, you're gonna get your money back. These securities also offer consistency. You know exactly what you're buying, the length of time for maturity, and the interest rate that you're gonna be getting. Unlike a high-yield bank account, which can change its rates at any given moment, good or bad. Next, the purchase limits are extremely high. If you want to buy $100,000 in treasury bills, that option is available. In fact, you can buy up to $10 million worth of non-competitive treasuries. And last, the interest is only taxed at the federal level. They exclude taxes at the state and local level. Overall, treasury bills, notes, and bonds offer a sense of security and consistency, which is something many investors are looking for whenever there's uncertainty in the market like you're seeing today. Now I'll move on to how you can purchase these securities, and there happens to be 4 different options that I'll be discussing. And they are new securities directly from the government via the Treasury Direct website as either a non-competitive or a competitive bid. And I'll explain more on that a little bit later. The second is new securities from either a bank or a brokerage account like Vanguard, Fidelity, etc. The third option is from a secondary market, which also comes from a brokerage account. And the fourth is to buy treasury bills and bonds in the forms of an ETF or exchange traded fund. Let's look at the Treasury Direct website to see how the buying process looks. As I'd mentioned, there is the option to buy bills, notes, and bonds competitively and non-competitively, and the overall process is called an auction. The competitive process means that you are bidding on the asset with your requirements for what you want as the interest rate. This is rarely done by individuals, and it's mostly done by large entities like the banks or exchanges. When you make a competitive bid, the government can accept some, all, or none of your bid. Whereas when you bid non-competitively, you accept the terms of the interest rates and you are guaranteed the bill, note, or bond. For the individual investor, think of the term auction as being used simply because the government has a window for purchasing these securities, and they are not instant transactions. The first step should be to research the historical and upcoming bills available for purchase. I begin by searching for treasury bills in the search tool, but I'll leave a direct link in the description below. From there, I look up the prior auctions to see what bills were being sold for. As you can see, there's a column for the issue date, the maturity date, high rate, and the investment rate. The investment rate is what the government guarantees for the rate, and the high rate is the actual rate given to the bill, note, or bond. The actual rate fluctuates during the auction based on supply and demand. If there's a huge supply, then the high rate will probably be higher than the guaranteed rate to promote more people to buy them at a discount. Now that you've researched historical rates, you can look at the upcoming auctions to get a baseline of what the rate will be. When you are ready to purchase your bill, note, or bond, you must be logged into Treasury Direct, and you can see there's a tab on the top for Buy Direct, and it lists the securities available over the next month. You can make your selection along with the purchase amount with a minimum of $100. Select your source of funds or bank account for purchasing them, and you can make the choice to reinvest a bill automatically when it matures. Lastly, you select the account where you want the matured security to be deposited. Hit submit and you've completed the transaction. Now that we've seen what the process looks like for Treasury Direct, let's transition to what the process looks like from an exchange, like Fidelity, for buying a new Treasury bill. You'll want to click on the investment products and select fixed income bonds and CDs. From there, select Search for Investments, and it brings up a slew of options. For new bills, I select the New Issues tab. Next, I select an available bill to look at the details and the performance. If I choose, I can hit the Buy button right now. A key item I want to point out is that the quantity field is in increments of 1,000. So if you input a 5 for the quantity, then you're going to be buying $5,000 worth. Similar to Treasury Direct, you can choose to auto-roll the investment where Fidelity will reinvest the initial investment in a like item. Some people like this feature, but I do not. I like to assess the market and make decisions as needed. With an exchange like Fidelity, you have the option to purchase Treasury bills, notes, and bonds on the secondary market. This means that you can buy one of these securities that are owned by someone else where they're looking to sell them before they mature. The process is similar to buying them new, but you select Bonds tab and it highlights secondary, and you can select in the drop-down what you want. From here, there are a long list of bills in this case where I'm selecting one that matures in 12 months, but you can select one that matures at any of the different maturity dates. The secondary market is sort of like using eBay to sell something. Even if the item is brand new, you'll have to sell items for a little bit less in order to move them. But the secondary market does come with added flexibility. It's just another option for making your purchases. In addition, this process is very transactional and immediate, which is unlike a new security that happens within the government window or an auction. The fourth option I'm speaking to for buying Treasury bills, notes, and bonds is from an exchange, but it will be in the form of an exchange traded fund or ETF. If you don't understand what that is, then I made a video outlining how an ETF compares to a mutual fund, and you can review that to learn a little bit more. I'll merely show that in Fidelity, you have the option to select the ETF tab, then select government, and it provides a list of different ETFs that are comprised of Treasury securities. And with an ETF, it comes with all the flexibility like trading stock. You can buy or sell as you like. Granted, it also comes with a small management fee that you need to be aware of, just like any other ETF. Now that you've observed the different purchasing portals, I think it's important to cover the pros and cons of each. And I'll start with the pros of buying these securities directly from Treasury Direct. The first pro is early access to purchasing securities. You can see the option to buy about 4 weeks out and put in your order in advance. But when you buy them from banks or an exchange, they only show you the securities that are available over a couple-day period. Treasury Direct also offers low minimums. You can purchase Treasury bills as low as $100 and in $100 increments. As for the cons, the site and the experience are less than great. The Treasury Direct site looks like a bad website from 1999. In addition to that, I've heard of a lot of people having their logins on hold, and the process to reset your login information can be a complete nightmare, sometimes requiring you to fill out a form and mail it in, which could take weeks to complete. In addition, selling assets is extremely slow if they've not yet matured. And once again, you need to fill out a form, mail it in, and route the asset to either your bank or an exchange so they can then sell them and give you the cash in return. But this is only if you're selling the bill, note, or bond before the maturity date. However, if you wait until the maturity date, the funds are deposited directly to your bank account. I appreciate the pros from the Treasury Direct website, but because of the cons, I would not choose to buy them from Treasury Direct. Which leads me to the pros of buying new securities from an exchange like Fidelity. For starters, the site functionality is user-friendly and it is robust and easy to navigate. Also, the ease of buying and selling is very smooth. There's no paperwork. You simply click on the button for either buying or selling and you're all set. Since it is an exchange, you can buy these bills, notes, and bonds in your 401k, IRA, or 403b if they're available to you. And if you need to liquidate the bill, note, or bond, then you have immediate access to the secondary market to sell your security before the maturity date. Once again, no additional paperwork involved. As for the cons for using an exchange, the first is that you have a very short window for seeing the securities that are available. You need to log into the exchange and make the purchase during the specific window, which you can see in this table here. Second, the minimums to order are quite high at $1,000 and they're in $1,000 increments. I'll now move on to the pros of buying these securities from the secondary market. And the first pro is that it's very transactional and immediate. It's more similar to buying stock. Once again, the site functionality is great and the buying and selling process is very smooth. But the con for the secondary market is that the rates tend to be a little bit less than new securities. And when it comes to ETFs, they are extremely transactional and trade exactly like stock. There's no need to look up maturity dates or anything like that. And the biggest con is that ETFs come with fees. As with anything in life, there are trade-offs with each of the different methods for purchasing the Treasury bills, notes, and bonds. I tried to spell out each of those trade-offs so that you can make the best decision on your investments. That concludes my video of walking through the different options for purchasing Treasury bills, notes, and bonds. And I hope you were able to get some value out of this video. As always, be smart with your money.